If you've ever explored investing or looking into any type of retirement planning topics, you've probably heard the topic of risk come up a lot in reference to your investments in your retirement plan. Is it really that important when it comes to retirement planning? Find out as we discuss in today's video. Hi everyone, Logan Sadler. Thanks for stopping by the Financial Beat YouTube channel. And on today's video, we're going to discuss risk, right? We've talked about this in some other videos in the past. As a financial advisor that meets with clients, this is something we always have to talk about because, as we know, pretty much every investment out there comes with some sort of risk. So again, that's going to be the topic of conversation today. If you haven't yet, go ahead and click subscribe or check out some of our other videos. I always like to tell clients risk is not a bad thing. Risk can be a very good thing for portfolios and can be, work out very great for some people. But depending on how much risk you're comfortable with, to us, is really the sweet spot that we're trying to find with a client. The right amount of risk to give them the returns and the upside that they would like. But when the downside comes, that we're still comfortable with the downside of the investments. Because let's be honest, every investment doesn't just go up forever or isn't always good, right? There's always fluctuation. And that's what we want to talk about on today's video. One of the things I love to do with clients when they come in is, especially if it's a new person coming in to interview our firm, what we'll do is we sit down and talk about them and their family, what they're looking to achieve in their retirement plan, what their goals are. And then one of the things we like to cover is risk. I'll ask them, hey, what has been your experience with risk tolerance or market volatility? A lot of the times, again, we work with a lot of retirees going into retirement. So most of the time the conversation is, well, I know I'm getting closer and closer to retirement. Should I be scaling down risk, right? So we'll look at their current portfolio and we do kind of a risk assessment where we'll cover a lot of those intricate parts of questionnaires, right? Where how much loss do you think you're comfortable with? And we actually are able to get a risk score for the client. So we'll go over, based off of your holdings and based off where you're at, this is how, how aggressive your portfolio is. And then this is what that means. This is what that translates to. If we had a bear market scenario, here's what could happen, right? And I popped up a little visual for you guys right here to look at. This is actually a client we're dealing with right now who wanted to be around that 60 risk score. And you can see the effects if we had a down market. Here's what that would look like. As well as we like to show the historical averages of an account like that or a model like that, because it's very important to understand not only the pros, but also the cons, because again, every investment carries risk. Now, once we get that realistically nailed down, again, not just talking about positive return, it's very important we cover risk. A lot of people out there aren't sure what investments carry risk. Almost all investments out there carry some sort of risk. You look at stocks, mutual funds, things of that sort, ETFs, those carry risk due to the market, right? They could fluctuate due to markets. You look at bonds. A lot of people aren't familiar with bonds. They've always heard those as a safe alternative. Most bonds out there can fluctuate in value. We're seeing that a lot over the last few years where bonds haven't really been doing exactly what a lot of people thought they should do during these current environments. As well as cash. A lot of people out there, have the mindset cash is king, which I do agree to a certain extent, but you really got to look at cash does carry a risk. You look at the last few years of high inflation, that is the risk on cash, right? Is that inflation might be eating that up and it's hurting your buying power. So it's so important to us when we're sitting down and building out a retirement plan that's going to need to last maybe 20 or 30 years in your retirement to make sure we really have a risk score that's acceptable for you. Mike Tyson has a quote that I always like to talk about. It's not the most, gentle quote, but it's basically, everyone has a plan until they get punched in the mouth, right? And that's kind of like how the stock market works. If you're being too aggressive at the wrong time, all of a sudden we have a pullback and you might lose maybe 20 or 30% or 40% depending on the correction. If your first instinct is to get out of the ring, right? Meaning to get out of the stock market or move to cash or do this or the other, you're probably not in that right portfolio or the right comfort level for your situation. So it's so important to understand there are investments out there that you can kind of sprinkle in to your retirement plan, whether that be fixed annuities that provide a guaranteed rate of return, fixed index annuities, structured notes, bonds, bond alternatives, all these different things out there. Real estate could be a good one, and then cash and all this other stuff. So it's important to make sure we're mixing those into a retirement plan to help get our risk score more acceptable and more in our risk tolerance for what we're actually comfortable with. Again, you want to be comfortable with this in the uptime but also in the downtime to make sure that we're taking the right amount of risk for you and your family in the retirement plan. I had a client come in recently who I asked the question, we went through our process and we were talking, and she was a new client coming on board, and I had asked her, I said, hey, listen, do you have any idea about where you rank risk-wise? And she's like, well, my overall portfolio, I'm very moderate, right? She was like, she likes that word moderate. So perfect, no problem. So I had her send me all her statements. I got her current risk tolerance. Everything else checked out to where she should be probably, let's say, a 50, right there in the middle of the moderate range. I actually ran a list of all of her investments, all of her different accounts. She came back at an 89. Okay, so an 89, 0 being conservative, 100 being the most aggressive. She was almost as aggressive as you can get with her entire portfolio. So if we were to suffer any type of bumpy turbulence like we've seen here lately, and like we always kind of see depending on what the market's doing, it was a real shocker to her how much her portfolio was affected. So what we were able to do is get her a portfolio that was more in line with her retirement plan and her risk objectives to kind of smooth out the ride over this thing we call retirement, right? So, there's a lot of different ways you can do that. If you are not sure of your risk tolerance, it's very important that you get aware of it. Make sure you're having that conversation. If you do things yourself, make sure you're really being realistic and do the research it takes to know the risk of each of the investments you're in and how it works to your plan. And if you're working with an advisor, you really want to make sure you're bringing that up as far as what are the overall risk of my plan and what would happen in a good scenario and a bad scenario. That is so, so important. I hope you guys found that video very insightful. Again, if you haven't, go ahead and click subscribe. We'll see you back here every week with the Financial Beat. Thank you.